Hey everybody, welcome back to Chipstock Investor. It's an exciting week. It's Nvidia's GTC. We'll see if Nvidia unveils some new information that saves us all.
From the market correction, I guess we're back to that again. Nvidia saving us all from correction, bear market, recession, tariffs. I don't know, probably not tariffs.
The other great news is it's spring this week, which is one of the reasons Nick and I look so terrible. We have allergy eyes. Sorry that you have to look at us. We'll make sure we put plenty of slides up here because it's spring.
You look great. Me, not so much.
But what we're really going to be talking about on this episode is Oracle and how Oracle's most recent earnings report actually gives us some great information regarding the market. Before we continue, quick word from the sponsor of today's video, public.com. If you are serious about investing, you need to know about public.com.
That's right. Public.com is the broker platform where you can trade literally anything. Stocks, bonds, ETFs, even cryptocurrency. And they have some great research tools built directly into that application.
Public also has a new AI tool called Alpha. Check that out as well. Fund your account in 5 minutes or less at public.com/CSI and get up to $10,000 when you transfer in your old portfolio. That's public.com/CSI.
But to tee all of this up, let's zoom out and look at the big overall picture to provide some context for Oracle's recent earnings update. So let's first look at this table from tech researcher Gartner, worldwide IT spending forecast in 2025. I think there's a lot of investors that still don't realize just how big the whole IT sector overall is. Expected 10% growth for 2025. I have a suspicion this growth rate expectation might come down a bit in light of recent events in the last month or so. But expected 10% growth as of January 2025 to $5.6 trillion worldwide on IT spending overall. And within that, data center systems are less than 10% of that total spending at an expected $406 billion, a 23% year-over-year growth rate.
When we're talking about data center spend, what exactly are we breaking down here?
So what specifically falls into this category is infrastructure services, or IaaS. You can see on this slide, again from Gartner, expected roughly 25% year-over-year growth for actual infrastructure as a service. That's hardware installed in a data center and rented out to companies for computing needs, storage needs, you name it. We also have cloud application infrastructure services. They're at the top, expected 22% growth. We talked about that a bit when we were discussing CoreWeave last week. And then finally, as pertains to Oracle and our discussion here, cloud application services, or SaaS, software as a service infrastructure, expected 19% year-over-year growth. Now, Casey, you put this slide together for us to help everybody understand who exactly we're talking about when we are discussing the primary companies spending these now hundreds of billions of dollars per year on these data centers and the computers inside of them, the servers.
We've broken down the spending amongst the major hyperscalers. Let's focus on Amazon for just a moment. They're the biggest spender, $105 billion forecasted this year in 2025 spent on CapEx. Now, Amazon's a little bit different. They don't specify what's being spent on their e-commerce business versus the data center, but we do know that a very large portion of this, in fact, the majority of this is being spent on data center infrastructure. Google coming in second, $75 billion for data center infrastructure. Microsoft Azure, $63 billion. Meta, somewhere between $60 and $65 billion. And then Oracle, which is what this video is about, just a very small fraction of that. Only about $16 billion spent in fiscal year 2025.
And that's an important note because fiscal year 2025 ends in May for Oracle. So we're going to get a new forecast for fiscal year 2026, which will begin in June, in just 3 more months. So that'll be an important update for Oracle in 3 months' time. We'll probably circle back to this topic. But the point here is all of these companies are increasing their capital expenditures on these data centers, not just for AI, not just for training, not just for inference, but in general, accelerated computing. And the reason why they're increasing these expenditures on data centers is because they have the customer demand. Customers need this computing infrastructure. And some of this is just brand new demand, especially in the AI department. A lot of software startups experimenting with AI training. But there is still all of this traditional IT spend that's not in the data center yet that continues to migrate from an on-prem in an office building, in some sort of server stuffed in a closet somewhere, or maybe a company's private data center migrating to some sort of cloud. So remember the big context here. The IT sector overall is huge, and the cloud is still a very small portion of that overall annual spend.
We'll do a quick rundown of Oracle's revenue from this most recent quarter. And in this video, we're going to be focusing solely on their cloud revenue. In Q3, cloud revenue, that's infrastructure as a service, as well as their software as a service, came in at $6.2 billion, which is up 23% year over year in US dollars and 25% in constant currency. And below that, in this slide, you can see how it's broken down into two segments. The infrastructure as a service was about 2.7 billion, and then the cloud application or software revenue was 3.6 billion.
Yeah, epic growth continues in that infrastructure segment. Remember when we talked about CoreWeave and the Neo cloud providers that specifically focus on GPU infrastructure? We can almost classify Oracle infrastructure as a service as a type of Neo cloud. This is kind of a new thing for Oracle, especially within the last 5 to 10 years. And they really jumped the gun on those larger hyperscalers back in 2022 when they announced this new strategic partnership with a data center infrastructure hardware provider called Nvidia. And then suddenly everybody cared an awful lot about that in spring of 2023 when Nvidia starts reporting an extra $4 billion in revenue that they weren't forecasting 3 months prior. Oracle is kind of the company that got this party started in the first place by recognizing the value of those NVIDIA GPUs. Now, Casey, the question continues to arise here. At what point does this party come to an end, or at least maybe a temporary end? When does Oracle and the larger hyperscalers, the cloud providers, when do they have enough GPUs? Is that time coming?
There's a lot of discussion about this. The demand continues to be more than the supply. And CEO Safra Catz made this point. However, she did say that they do expect the component delays, aka those GPUs, those Blackwell systems that have slowed the cloud capacity growth up to this point, should ease in Q1 fiscal year 2026. So in June, they should start to see some easing of that supply versus the demand.
Now, I think our main question here is, who is this bad news for? Is this really bad news for NVIDIA, or is this potentially bad news for some of those other neo clouds? Remember, we talked about that with CoreWeave, Nebius, Applied Digital, so on and so forth. They picked up a lot of revenue because customers were not able to get enough GPU AI training capacity at the traditional hyperscalers. So Oracle and those other neo clouds benefited from this early wave of AI training and AI adoption. So our question, I think, becomes, is this really bad news for NVIDIA, or is it perhaps worse news for Oracle? And I think Oracle is saying here, this isn't maybe as bad as we think it will be. At least that's their initial outlook.
Yeah, Oracle made it very clear that their viewpoint on the outlook has not changed. The CEO continued to say that they really have a clear line of sight into their future revenue growth, and they doubled down on their confidence that they can meet the $66 billion revenue target that they have for fiscal year 2026. So they're not concerned at all that demand is going to start to fall off.
Yeah, it seems like as they get more GPUs installed into their data centers. The backlog of customer or remaining performance obligations is there to gobble up that extra GPU capacity as soon as it goes online. And so the forecast here was actually for fiscal year 2026, cloud revenue to be stronger than ever, pushing the overall growth rate for Oracle up to 15%. That's the cloud plus the older traditional Oracle software business. And then more importantly, they also expect fiscal year 2027 growth rate to be around 20%. Again, because of the cloud infrastructure demand that they have. Perhaps more Nvidia GPUs being available actually isn't a bad thing. In fact, it could be a good thing because it can help companies like Oracle and the other hyperscalers as well actually increase their revenue because there's just that much demand for this accelerated computing.
Now, the question may come up, how in the world is Oracle only spending $16 billion in fiscal year 2025 in CapEx for this infrastructure, this data center infrastructure? Why are they doing so well and spending so much less than Amazon, Google, Microsoft, and Meta?
Yeah, that's a good question. And actually, Casey, you've had this question, and an analyst asked this same question exactly on the earnings call. And CTO and old co-founder of Oracle, Larry Ellison, had an answer. So remember, Oracle is newer at this data center and cloud infrastructure business. Historically, they are a software business, especially database software. There is so much data sitting in Oracle databases around the world, but on-prem. A lot of companies still house their data physically on the site, not in the cloud. And so when Oracle builds a new data center at this new cloud region, they just hit their 101st cloud region recently, this data center location on the map here, where they can offer services close to those customers where they actually reside. They're able to start very small versus the bigger hyperscalers, Google, Amazon, AWS, Microsoft, Azure. They have traditional cloud infrastructure. The workloads are bigger. And so the spending, therefore, is larger as well. Oracle can start with a much smaller footprint and then gradually ramp up the capacity in that new data center region as the customer demand increases, as they migrate more of their old on-prem databases and other workloads to the Oracle cloud infrastructure.
So I guess in summation, Oracle's not one that we own, but it does give us some good indication on what's going to happen with some of the companies that we do own, Amazon, Meta, Google, in the upcoming year.
Yeah, and an important point here, because a lot of investors continue to be concerned with the return on investment for that CapEx spend. But Oracle demonstrated once again, the unit economics for cloud infrastructure are still incredible. These companies are very cautious with their CapEx spend. They're careful not to invest in the infrastructure and the Nvidia GPUs unless the demand warrants the expense. And so Oracle showed that off with, yet again, faster earnings growth than revenue growth. And that's what all the hyperscalers were able to demonstrate in the latest quarter as well, with perhaps Microsoft being the big question mark here because of the souring relationship between them and OpenAI and ChatGPT. But as far as we're concerned here, at least for another 3 to 6 months, the coast looks clear to us. The bull market is still intact. What we witnessed here as of late is just a very normal and healthy bull market correction, inter-bull market correction.
Thanks everybody for watching this episode of Chipstock Investor. Make sure you hit the subscribe button. Check out our new newsletter, completely free of charge. Get it every Wednesday in your email inbox. Sign up for it in a link below. Check out our Semiconductor Insider membership. That $10 a month gets you access to Discord, where you get our live stream of thought, which could be a good thing.
I think it's usually a good thing. We're going to go with it. It's a good thing.
It's a good thing.
We've been told we add a lot of value. Check us out.
Take care, everybody. See you again soon at Chipstock Investor.